Rent growth in several apartment markets across the U.S. is slowing down a little bit, but pricing power in Orange County has just reached a 10-year high. We'll take a look at the influences shaping that performance pattern on today's edition of Apartment Market Dynamics from MPF Research. I'm Greg Willett. Cameron McIntosh is here as well. Cameron, bring us up to speed on those Orange County rent growth stats.
Annual growth in effective rents for new leases in Orange County has run around the 6% mark for the past couple of quarters, just under that figure as of second quarter and just above it at 6.3% as of third quarter. That's a nice acceleration from annual increases that generally were in the range of 4 to 5% earlier in this cycle.
More aggressive pricing for Class A units accounted for most of Orange County's recent bump in the annual rent growth pace. Annual growth is at 6.7% for these top-tier properties, up from 4.5% a year earlier. While there's been a little uptick in rent growth for Class B units too, it's really those Class A properties that have moved the needle.
Orange County's current occupancy reading stands at 97.3%. Technically, that's the best performance seen so far in this cycle, but to some degree, saying it's the best is splitting hairs. Occupancy has been hovering around that 97% mark for 2.5 years. The really tight occupancy is registering at a time when deliveries have been running around to 3,000 to 4,000 units annually. That's about as big a tally as we've seen locally over the past couple of decades. But it's still a fairly reserved growth pace relative to the activity seen in many locales.
If Orange County is going to maintain its impressive rent growth pace, we'll need to sustain the big increases in top-tier properties. That's a pretty tough assignment since the amount of new supply moving through initial lease-up is about to climb further. Let's look at the Metro's construction figures. Ongoing building is at 10,841 units. The annual completion volume is set to go to about 5,000 to 6,000 units compared to recent levels of 3,000 to 4,000 units.
The good news is that the upcoming new supply total is a little less intimidating when you realize that the additions will be spread out across quite a few different neighborhoods. As you see on this graphic, 5 different submarkets have at least 1,000 units under construction, but there's no place where short-term completions will exceed 2,000 units.
Expected occupancy in Orange County remains healthy, though a dip of 50 to 100 basis points from today's stellar rate seems likely. Following that same pattern, rent growth should cool a bit from where it is right now, but the resulting figure of 4 to 5% is still very healthy.
Like the rest of Southern California then, Orange County looks well positioned over the near term. All the metros in this region are anticipated to at least slightly outperform the U.S. as a whole over the coming couple of years. Thank you for joining us on this edition of Apartment Market Dynamics from MPF Research. I'm Cameron McIntosh, he's Greg Willett, and we'll see you next time.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.